You're welcome. Please, we are waiting for the rest to join so we can start. Kindly exercise patience while the rest of the class joins. Thank you. Okay. We'll be starting the meeting regardless of the attendance. I'm going to be, my name is Amina Adam. I'll be your moderator for today. So I'll be reading out the mentors' profiles. Okay, one of our mentors is here, so I'll start. You're welcome, sir. Okay, I'll be sharing my screen. Okay. Okay, our first mentor for today is Mr. George Onyeuchi. George currently heads Fintech engagement for First Bank and its subsidiaries across Africa and its Digital Innovation Lab, setting up and driving the bank's Fintech strategy. George is a link that connects technology, business, and ecosystem partnerships. He's at the intersection of products, partnership, and ecosystem building. He has led the tech solutions product development for the SME banking business of a leading commercial bank and has taken numerous financial and non-financial products from idea to market and growth. He has led digital transformation in the client engagement processes for leading commercial banks, including one of Nigerian banking industry's first end-to-end account opening for corporate accounts and SME digital lending. His team have won numerous awards for powering growth of SMEs. He also provides advisory for CRIP Africa toward developing blockchain infrastructure and building the operating system for African businesses on the blockchain, and hosts knowledge sessions on blockchain application to various industries within the African context. Our second mentor is Mr. Christian Gombo. Christian is a senior consultant as EY as part of the Fintech team, working with scale-ups and large firms across RegTech, payments, and crypto assets. He has prior experience as an open banking consultant for a fast-growth SaaS fintech in London, working with EMIs and Tier 1 banks on their digital transformation projects in line with regulatory technical standards set by relevant NCAs. Chris has extensive experience in business intelligence within technology, working with cloud-agnostic global firms to deliver growth strategies and operational models with collective deal sizes exceeding 3 million British pounds. Kristen holds a Master's of Science degree from University College London, UCL, with a special focus on economic policy and geospatial analysis of key value chains. Our third mentor for today is Mr. Peter Cole. Peter is a legal associate with Nigeria's premier corporate commercial law firm, Chris Obumbanjo LP. He provides cutting-edge legal expertise at the intersection between law, technology, intellectual property, and finance. His professional legal expertise centers on novel areas of law, including technology law, intellectual property, and startups, AI, and fintech advisory. He also provides strategic legal counsel to early-stage, emerging, and high-growth startups /venture founders and their funders, whether private equity, venture capital, or angel investors. He is a member of select professional bodies, including the International Bar Association, IBA, International Technology Law Association, ITech Law, Fintech Association of Nigeria, Fintech Nigeria, Young International Chamber for Commercial Arbitration, Young ICCA, and the Startups Law Global Institute. Before pursuing a full-time career in legal practice and advisory, Peter Cole co-founded/led impact startups and social impact initiatives, winning awards for innovation and social enterprise. He is a fellow of the Savvy Fellowship, the 0 to 1 High Impact Fellowship, an ambassador with the World Literacy Foundation, and an alumni of the Holt Prize Global Enterprise Challenge. Thank you so much for joining us. Let me check to see how many of our mentors are here. Okay, we have one mentor here. Thank you so much for joining us, Mr. Peter Cole. I'll be giving you the floor to give us an overview of today's topic. Over to you, sir. Hello, am I audible? Can everyone hear me?
Yes, I can hear you.
Hello, Amina, can you hear me?
Oh, yes, I can hear you now, sir. Welcome, sir. Thank you so much. Good afternoon, sir.
Yeah, so while we await the presence of the other mentors, I've been asked to give an overview of the topic, so I'll just proceed to that. I believe you can hear me very clearly. You can also see me,
yes,
right?
Sir. Yes, sir.
Yeah, just to explain that I'm dressed this way because, I mean, it's a Saturday and you know how Saturdays typically are. I had to escape from an Owambe event to just have this session. I've been committed already to it.
We apologize for dragging you, sir. Thank you so much for being here.
Yes.
Really appreciate it.
Ladies and gentlemen, it's a very great pleasure to be here once again. I think last year I was part of the portal on the historical review of fintech and how it relates to intellectual property. But I'm very pleased to be part of this session today, which is all about examining, reviewing, and analyzing the relationships between fintech contracts, generally, fintech contracts, and transactions. That's what we'll be examining today. First off, I think I should give a thumbs up to the team. Your research, your presentation was something, you guys extensive, the need to really different sets of this topic. So just to provide we're talking about a sector that is growing in leaps and bounds in Africa, not in Nigeria only. There's a projection that was recently released that estimates that by the year 2050, it is likely that tech, the top tech now reside in Africa. Now, that prediction is just suggesting that we've taken a lot of steps forward and we made inroads with respect to the placement of fintech, the fintech industry in Africa. Now, when you talk about can you hear me?
Sorry, sir. Can you take the last sentence again? We didn't really get you, sir.
Sorry, can you hear me?
Yes, sir, we can hear you, but you're breaking up at some point.
Oh, I am breaking. Okay.
Yes, sir.
Is it any better now?
Yes, sir, but we can hear you now, but not very clearly.
All right, I'll try to speak louder and hope and pray that the audience can hear me clearly. So
yes, we can hear you.
We have a projection currently that the fintech industry in Africa by the year 2050 will likely be if not the biggest, but one of the biggest fintech segments globally. Now, that projection and prediction places into perspective the very, very vital role that the fintech industry is playing in Africa. When we talk about fintech, we all know that basically we're talking about the intersection of technology to make financial services more effective, to complement and to ensure that the delivery of financial services is made more seamless. That's basically what fintech is about. It's about applying technology to address challenges in the financial services industry, or to improve the process as a whole. So that's what is meant by fintech visually. So when we're referring to contracts and transactions in fintech, what we're basically looking at is we're considering the various ways and the variety of business models that can be used to contract and to do business in the fintech industry. Now, the fintech industry in Nigeria and in Africa as a whole is a very, very vital part of the economy. As we speak at the moment in 2023, about 5 African countries, Kenya, South Africa, Nigeria, you could also add Egypt, and lastly, Rwanda, all together as a whole, in terms of the fintech, the size of the market in fintech, they've been able to, transactions that have happened in that segment this year alone have reached close to $1 billion. Now, funny enough, there were projections late last year that due to the state of economy and the fact that there were challenges, that perhaps by the end of the year, Africa would not have reached $1 billion in fintech transactions. But it's startling and it's amazing that this projection has been made to look poor, because now, as at Q2 2023, the combination of all these transactions and their work have reached close to $1 billion. But it's not about the work of these transactions alone. The question which we need to ask ourselves, especially as lawyers, as advisors in this space, how are these transactions? How are they handled? How are they conducted? And that's what this session is all about. To give put into perspective the structure, the processes, the manner, and the approach to which fintech transactions and contracts are conducted and they take place. Now, for a start, when we talk about contracts, we're talking about, because this is a commercial service segment, right? And we know that when we talk about fintech, we usually talk about the innovations in the SaaS industry, using software as a service, or all that kind of. So in that kind of segment, you need to talk about how commercialized those contracts can be, and what is the structuring of these contracts, right? is there a particular contract approach that you need to use to fintech products or innovations that you cannot use, say, for instance, in another segment? That's what we want to be examining. And I'm hoping that by the time the other mentors come in, we'll be able to touch on this very, very key aspects. And most importantly, we cannot talk about fintech and contracts without referring to the hobby of smart contracts, right? Understanding that what enables fintech in the first place is the technology. If you take technology away from fintech, it just becomes another random traditional system of banking, which cannot properly facilitate the growth of the industry. Now, there's a statistic that says that currently, even despite the achievement and the progress that Africa has made in fintech, as of now, about 52.5% of the African population as a whole is still unbanked, right? About that segment, that 52% is still lacking access to mobile banking, is still lacking access to fintech products, which means that there's a ready market already. Understanding that, and there are innovations that will come to the fore as time goes on. But what we seek to answer here, which is what we will be discussing with the mentees today, is how exactly should these transactions, should these contracts be structured? Now, I've talked about the issue of commercial contracts. We generally, financial services providers often have agreements. These agreements are vital. They're agreements that fintech usually make to be able to examine the technology capabilities. So if, for instance, you have an innovation, let's say you have a fintech startup, you are Paystack, you're Flutter, for instance, and you have a product in that industry, how are you able to contract properly with not just your client, your customers, right? Not just the people you service, but also the technical personnel. Now, don't forget again that the most important component of the fintech industry is not the financial services, but it's the technology that enables that financial services to thrive. So the technology is important, and the technical personnel that make the technology important have to be properly contracted. You have to ensure that there are clear lines drawn in their contracts with respect to the ownership of intellectual property, the usage of data. A vital part of fintech is the usage of data, right? That's vital. And that's why the Data Protection Act 2023, which was recently passed, becomes very vital. As a lawyer, understanding regulation is vital, but understanding how to apply them is even more important. You have to know what applies to the fintech space. You have to know what laws, what regulations are in place, and how to be able to cater to that. Well, generally, so this is a bit about that, and most prominently is the topic around smart contracts. How smart are smart contracts, right? That's a question I believe before the end of the session we will be able to answer. So just as an overview, once again, to touch on the fact that the presentation slide that was sent in by Tim was not bad. It was a very, very good attempt. You analyzed properly the issues, you touched on the subject matter, and you were able to profile from your own perspective what the nature of fintech transactions or contracts should be. And our job here as mentors is to guide you, right, and to tell you how these steps are taken, how the contracts are drafted and written, how they are reviewed, and the essential parts and components of fintech transactions or contracts. So I'll stop here for now. I'll use the floor to other mentors to get into the nitty-gritty and the rudiment of the topic so that we can then properly understand and then move on that note. Thank you very much, Amina. I yield the mic for now.
For that comprehensive overview. The next item on the list is presentation from our mentees. And today's presenter is Gerard. Gerard is on the call, so Gerard, you can start your presentation.
Okay, thank you very much. Come, let me share my screen with you guys.
All right.
I don't know if you can see my screen.
Yes, we can see your screen.
Okay. Okay. Okay, so our presentation for today is fintech contracts and fintech transactions. So our table of contents is on the meaning of fintech transactions and fintech contracts. Then I will also talk on the types of fintech transactions, fintech transaction processes, the advantages and challenges of fintech transactions. Then I'll move over to fintech contracts, how fintech contracts differ from other traditional contracts, then smart contracts, the benefits and challenges of fintech contracts, then fintech regulations. Firstly, what is fintech transactions now? Fintech transactions means using technologies like mobile apps or online platforms to do financial activities. For example, sending money to a friend through a payment app or buying something online by using digital wallets are all types of fintech transactions. Then what are fintech contracts? Now, fintech contracts is a kind of written agreement that is made by fintech companies to handle different parts of their services like products and partnerships. Then we also have the fact that these contracts govern various aspects of fintech services like products and collaboration. They outline the rights and duties of the people and the companies involved. Then also fintech contracts cover various areas depending on what the fintech company does. For example, if a fintech company partners with a bank to offer a mobile payment service, they would have a contract outlining how they would work together, what services they will provide, and how they will share share the profits. Another scenario could be if you sign up for a fintech app to invest money, you would likely agree to the terms and conditions through a contract, and these contracts will specify the fees you will pay and how you will manage your investments and what happens if something goes wrong. Then what are the types of fintech transactions? Under the types of fintech transactions, we have digital payments, and these are transactions done using technologies like mobile phones or the internet to pay for things. For instance, us using our mobile payment apps like Pega or OPay to pay for goods and services, transferring money like to our friends and families using platform. There is popular one. This GT Bank's 737 USSD code, or making online purchases on websites or e-commerce platforms. They also have remittance, which refers to sending money from one country to another. And with fintech, it has become, would I say, easier and more efficient to send money internationally because you can use it to pay for things that are international. For example, using platforms like Western Union or Remitly, or even World Remit to send money from Nigeria to other countries, and the money will be received abroad. Then we also have digital wallets, and these are like virtual wallets that will help you store and manage multiple payment methods like your debit cards or your bank accounts. And all these are done all in one place. Now, in Nigeria, you can use digital wallets like, I think, Flutterwave Bata, Paystack, or even mobile banking apps, provided that the banks store your payments and details securely. Then we have contactless payments, and this has to do with transactions where you do not need to like physically swipe your card. Instead, you can use like a near field communication, which is NFC, or you can scan QR codes to make payments. And in Nigeria, you can use your contactless enabled debit or even credit cards to make payments at stores that have these contactless payment terminals. Then we have the financial transaction and the fintech transaction process. And this process starts with user initiation, which is like the process where a user decides to perform a financial transaction, such as sending money to a friend or making an online purchase. And they do this by using a digital platform or a mobile app provided by a fintech company. For example, a user in Nigeria opens their mobile banking app to transfer money to a family member that is possibly inside the country or outside the country. Then after this, we have the next step, which is data encryption or secure data encryptions. And this is to ensure privacy or security that the user's sensitive financial information like his account details or card numbers are encrypted. And these encryptions makes the data unreadable to like people that are not authorized to the transactions, or they are unauthorized parties during the transmissions. Then we have the next process, which is transactions are processed and verified. That is processing and verification. And once the user initiates the transactions, intermediaries known as payment processors, they come in play as at this time. And these processors, can you hear me?
We can hear you.
Okay, now, so these processors are responsible for handling transactions and verify that the transactions are legitimate. Now, they check if the user has sufficient funds or the payment that the user is about to perform is valid. Then we have the last stage, which is confirmation and notification. And this is like after everything's over, the Fintech platform will send a confirmation message to the user, which we all have received confirmation messages that we have paid this money or we have done the transaction, we've sent the money to someone, and at the same time sending a message to the receiver that he has received the funds that was sent to him. Then we have the benefits of fintech transactions, and one of the benefits is speed and real-time transactions. Now, fintech allows like individuals to do financial transactions anytime and anywhere, like using their smartphones or the internet. And this convenience results in faster transactions without like needing to visit a bank physically. Now, for example, a person in Lagos can transfer money to a friend in Abuja, as I've even said before, and he can do this like through his mobile payment app. Then the second benefit is reduce dependency on cash. Now, with the recent SWIFT transactions offered by fintechs, the cashless policy is better implemented, as these payment methods can be done online without the need of physical cash, meaning you do not need to have physical cash on your hand for you to make payment. Then the third benefit is financial inclusion for unbanked and underbanked population. Now, what this means is that fintech products and services bring banking closer to those who previously like lacked these assets, people who did not have access to banking institutions like the traditional banking methods, because of like they do not have education or their locations are remote. For example, now fintech platforms could enable, let's say, individuals in rural areas like the northeastern part of Nigeria now to open like digital accounts and access financial services without even visiting a physical bank. Now, although we have these three benefits, there are also some challenges that exist in the fintech transactions. And one of these challenges is very important, which is cybersecurity risks and data breaches. Now, fintech services, like they handle sensitive information, that's sensitive financial information. And this information that they hold make them potential targets for like cyber attacks or even breach of their data. And these breaches or financial attacks puts a customer's data at risk. So this is a part of a challenge. This is part of the challenges that these fintech companies they face, and they need to look for ways to tackle these challenges. Another challenge they face is regulatory compliance and consumer protection concern. Now, fintech companies, they must adhere to transactions that happened, must adhere to transactions that happen online. That is, they must ensure that they operate legally. That is, they protect the consumers' rights. Then we also have potential frauds and scammer, which could also be related to cybersecurity, which often happen online, and there is a risk for fraudsters to attempt to scam or do fraudulent activities with these fintech companies. Then we have fintech transaction and traditional fintech contracts and traditional contracts. Now, what I want to talk about in this is the differences between the fintech contracts and the traditional contracts. Now, firstly, let me talk about the fintech contracts. Now, fintech contracts are related to services or goods offered by fintech companies. Now, these companies, they primarily deal with financial services like mobile payments, loans, and digital wallets, and they involve complex technologies like digital signatures or even authentication processes. And they often use smart contracts based on blockchain technology for automation. And these fintech contracts ensure smooth and efficient transactions between parties involved in the financial transactions. And another one is that they have global recognition. Now, these fintech agreements are recognized worldwide due to like their digital nature and blockchain technologies. While under the traditional contracts, they involve diverse subjects. They cover various like subjects like land agreements, marriage, business partnerships, and so many more. And they are not exclusively focused on financial services. They will also have the fact that the technology used may not be complex, and they don't use technologies like digital signatures that I mentioned before. And they also have like manual processing. That's like they require like manual paperwork compared to fintech contracts. And I said the fintech contracts are globally known, while these traditional contracts are like they have local recognitions. Then we move over to the fact that some agreements that fintech transaction takes, that the contract they make, they have clauses which strictly specify the content which is required as a minimum basis of the agreement. And this agreement, which has specified content and clauses, are as follows. The first one is P2P lending agreement, and P2P means peer-to-peer. That is peer-to-peer lending agreement, and they have specific clauses that must be included in them. Now, these clauses are essential for both like the P2P service operator, the lenders, and the borrowers to ensure that there's somewhat like clarity and fairness in the agreement. And the first one is the agreement number and date. And this refers to like the unique identification number and the date when the agreement is made. Then we have identities of the parties, and this refers to the names and details of the people that or the entities involved, such as the P2P service operators, the borrowers, or even the lenders. Then we have the rights and obligations of the parties, which it means that they are clearly outlining what each party is entitled to do and what responsibilities they have. Then we have the amount of loan. We all know what loan is, and that is like the specific amount of money being borrowed or lent. Then we have the interest rate, which is the rate at which the borrowed money will accrue interest. Then we have the period of the agreement, which is the duration or where I say timeline for the agreement to be in effect. Then we have other relevant fees, and these include many things. And these could be like additional charges or fees associated with possibly the loan or the services. Then we have provisions on fines, if any, and if there is any penalties for like late payments or breaches of the agreement, these where provisions of fines, if any, comes in. Then we have the details on collateral, if any, like if any assets or property are pledged as security for the loan, that's where details on collateral, if any, comes in. Then we have provision of fines, if any. Now, if there's any penalties for late payments or breaches of agreement, I think I've said this before, yes. Then details on collateral, yes. Then we have dispute settlement. Under dispute settlement, it's like the process of resolving disagreements or conflicts that may arise during the agreement. That's where dispute settlement comes in. Then we have commission rates specifically for agreements between P2P service operator and the lender. Now, the rate at which the P2P service operator will earn the commission from the lender, that's the commission rate. Then we have installments specifically for agreement between the lender and the borrower. this is like the schedule and method like for repayment, which may include like the amount and the frequency of payment, how much the person will be paying instrumentally. Now, additionally, the usage of standard agreement for P2P lending, the usage of standard for agreement for P2P lending, but the following clauses are prohibited in such agreement. This means that there are some clauses that are not allowed to be included in a standard agreement for P2P lending. And these clauses include the transfer of responsibility from the operator to the user, either lender or borrower. And this is the P2P service operator cannot shift their responsibility onto the user of the platform. Then we have the second one, which is stating that the user will comply with any new regulation or provisions that was once silently created by the operator, which means that the operator cannot like force users to comply with any new rule or regulations that they create without like the input or agreement from the user. Then the second one under these clauses that could not be included is financing agreement. And there are various financing schemes in Nigeria. And financial agreements in Nigeria is like a contract that outlines the terms and conditions of financial arrangement, such as, well, I say a lease or financing through like convertible bonds. Now, regardless of this specific scheme, there are certain clauses that must be included in all financing agreement to ensure that there is like clarity and protection for every party that is involved in the agreement. And one of these is the types of business and financing scheme. And this is clearly stating the type of business that will be involved and the specific financing arrangement that is being used. Then we also have the number and date of the agreement. And this is like assigning a very unique identification number and recording the dates that when the agreement is made, the identities of parties, that is the people who are involved in the agreement, that is the names and the details of the individuals or entities that are involved in the agreement. We have the identity of third parties in cooperation, if any. This is like mentioning any third parties who are involved in the agreements or providing cooperation. Then we also have details on the finance goods and services, including the purpose of the purchase of goods and the users of the services. That's very self-explanatory, which is like describing the goods and services being financed and explaining the purpose of their purchase and the usage. They also have purpose of financing, which is like clearly stating the reason why they are seeking financing. And we have the amount of finance goods and services, which is like outlining the total number like to be repaid and the periodic instrumental amounts, how much are we paying instrumentally. They also have the amount of account receivable and installment, which is outlining the total number of total amount to be repaid and the installments that are going to be paid. We also have the period of agreement, which is self-explanatory. That is the timeline for the agreement in effect. Then we have the interest rate, how much you pay as interest. Then we have the details on collateral, which is the assets or properties that are pledged as security for the financing. Then we have other relevant financing fees, if any, such as survey fees, insurance fees, provision fees, and notarial fees. And we have the details of fiduciary mortgage and hypothec rights, if any, which is like describing any rights that are related to security or legal interest in the finance goods or services. And we have dispute resolutions, including the mechanism for dispute resolution and the choice of place for dispute resolution, self-explanatory. Then we have provisions on warning procedures and execution of collateral in the event of default, also self-explanatory. Then we have provisions on mechanism for settlement of loan and return of excess amount for execution of collateral or insurance claim. This kind of means like that is you have the mechanism that you use to settle the loans and you have to return the excess amount. Then we have illustration on the distribution of principal financing, receivables, interest, and outstanding principal financing. Now, this is like providing a breakdown of how the financed amount will be like distributed, which may include the principal, the interest, and possibly the outstanding balance. We also have the rights and obligations of the parties, what each person is entitled to. Then we have provisions of fines, which is specifying like any penalties or fines that may be applied in case of no compliance. There is no compliance in case there's like fault in the agreement. Then we also have, in the event of financing scheme, in the event the financing scheme is a financial lease, the agreement must include a clause to prohibit the lease object to be subleased to another party. Now, this means that if the financing is for a financial lease, which includes a clause that is prohibiting the lease object from being subleased to another party, they will have to have a clear understanding of their roles, their responsibilities, the rights and duties that will ensure a fair and possibly a transparent financial agreement between them. Then we have smart contracts. Now, what smart contracts are like agreements between buyers and sellers that are like written directly into like lines of code, and they are self-executing. I rather say self-executing, meaning that they automatically execute once specific conditions are met. Now, smart contracts are used in fintech to make transactions faster and possibly more efficient, because they have like predefined rules and conditions that all parties must follow. Now, smart contracts have its benefits and challenges. And one of the benefits of smart contracts is the fact that it is efficient. It has efficiency and automation in contract execution, meaning that they like eliminate redundancy. That is like they are fast and easy to operate. Then we also have reduced cost by eliminating intermediaries, meaning there are no extra people coming in to like extra details like you need. Like there's no need to employ other people to do specific tasks, because it reduces the cost of doing fintech contract. We also have enhanced trust and transparency, meaning that the terms and conditions are written, since the possibly the terms and conditions are written in code, they will be like transparent and visible to all the parties involved. And we also have challenges, which is legal recognition and flexibilities of smart contracts. And what this means is that there might be challenges in getting like smart contracts legally recognized and like enforceable in traditional legal systems. And this like means that existing laws might not like fully address the complexities of contracts executed through codes, meaning that there's no like laws that are guiding these contracts that are written by codes. Then we also have code vulnerability and potential exploit. Now, smart contracts are written in code, and if there is no like there are errors and if there are like errors in the code, it could like lead to, well, I say, unintended consequences or exploits, like which may cause financial losses to the person operating it. Then we also have limited adoption due to regulatory uncertainties. Now, the adoption of smart contracts in Nigeria could be limited like due to, well, I say, uncertainties surrounding regulations. That is, like I mentioned before, under legal recognition, there may not be laws guiding these smart contracts. I don't know of any law though, but I don't think there's laws guiding these smart contracts, like the codes of these smart contracts. Now, for example, now a smart contract could, for a complex real estate transaction, might face like legal challenges if the existing property laws do not like fully recognize or address like the specific contracts that are executed through codes. If you get what I mean, like they do not recognize these smart contracts. Then we have fintech regulations. What are the regulations that are guiding the fintech transactions? Now, one of the
Mr. Gerard,
regulations.
sorry to interrupt you. Can you use like 2 minutes to round up the presentation so we can take comments from our mentors?
Yes, I'm in the last part right now.
Thank you.
Okay.
Okay.
Then we also have fintech regulations, and we have like the CBN Act, which is legal framework of most all the banking institutions in Nigeria. Then we also have the Nigeria Deposit Insurance Corporation Act, the Banks and Other Financial Institution Act, the NDPR 2019, which is Nigeria Data Protection Regulation Act. Then we also have the NDP 2020, which is the Nigeria Data Protection Act. Those are like the regulations guiding fintech transactions in Nigeria. Then for our conclusion, we had that fintech transactions and contracts have transformed the financial service industry, which is offering enhanced convenience, accessibility, and cost efficiency. And the adoption of digital contracts has streamlined processes, improved security, and improved and reduced operational costs. However, challenges such as cybersecurity risks and legal considerations surrounding enforceability and AI usage must be addressed to ensure that continued growth and sustainability of fintech. As technology and regulations evolve, fintech will continue to redefine transactions and contracts in the digital era. Okay, that is the end of my presentation, and these are my group members. Thank you very much.
Thank you so much, Mr. Gerard, and the entire group members for a wonderful presentation. While you were presenting, our second mentor for today joined Mr. George Onyewuchi. Welcome, sir. In comments from our first mentor, Mr. Peter Cole, on the presentation. Sorry, can you hear me?
Yes, we can hear you.
Sorry, did you get what I said? Sorry. I said, am I audible?
You are audible, we can hear you.
Okay, thank you. I was calling on our first mentor for today to give an overview, to give a comment on the presentation.
All right. Yeah, so it was a very, very good presentation. I like to give my kudos and well done for a good job to the last presenter. Was it on behalf of the team?
Yes, sir. On behalf of the team. Our mentor's network seems to be unstable.
I'm sorry, I didn't get that.
Sorry, sir. We didn't get your last statement, sir. You seem to be breaking off.
Understanding of the topic, and not only that, there was more research and there was also a lot of time was spent to describe the form in which the fintech contract usually takes, and the essential part of it. Like I emphasized previously when I was making my remarks, the most fundamental part of fintech is the application of technology to ensure efficiency and efficacy of financial services. What we have is a pre-written set of codes that now takes the effect and enables contract fintech to be done faster. Yeah. Right there around the intellectual property that is around codes can be written or can as well as any other technology.
Sorry, is it just me? Okay, okay. There's a message on the group that says his network is unstable.
It's not just you. I can't hear him
Yes,
clearly
I thought
too.
it was just me. It's like he has gone off completely. So while we wait for him to join, okay, he's here. Sorry, our mentor's network is unstable. So we'll be taking an overview from Mr. George before Mr. Peter Cole comes back. Good afternoon, sir. Thank you for joining us. Mr. George, okay, yes.
Can you hear me?
Thank you for joining us. Yes, we can hear you.
Yeah, good afternoon and lovely weekend. Sorry, I'm a bit here and there, so I couldn't get on time. I'm still a bit here and there though. So I will try not to take you guys back. I know you guys have already moved forward. Overview. Do you say overview or on the presentation? Which of them now? I caught just a little bit of that presentation.
Yes, I can do a bit of. Yes.
Yeah,
okay.
even though I've skimmed through it, yeah. But just not to drag us for a while, probably just combine both for the next 5 minutes. I'll just say like the topic in itself, it's a very interesting one, naturally, because it's at the heart of what you do after you're done setting up, your startup, right? After you say, I have a startup or I have a project and I've created a product, the next thing is, people have to use it, right? So there has to be transactions, and of course, there have to be contracts that would help you, even in the course of creating that startup, in the cost of creating that product, and the cost of customers using that product, there have to be different contracts, right? So it's naturally something that it's not avoidable. But when you combine transactions, and you say fintech transactions, and then of course contracts, they are two different things, even though they have a line where both of them cross each other. And a line where they cross each other is basically if those transactions are guided by, agreed terms, agreed understanding, terms and conditions or agreement, right? If that transaction is being bound by certain rules that has been mutually assented to, right, by you, the fintech, and by the other guy, the customer or the partner. So that is where they align, right? But they are they are two different things on their own, right? The contract and the transactions. In the presentation the guy had earlier, I think when I just scanned through it, he tried to define a transaction, right? The use of financial technology to facilitate, right, an activity or an action that would give value to a customer in whatever way. So if you use your technology to facilitate a form of financial transaction or a form of action that gives value to your customers. Of course, that is some form of transaction, especially where there's a monetary exchange of value, right? But when you come to the contract side of things, now you're talking about the rules, the agreements that you have both mutually consented to facilitate whatever relationship or whatever partnership or whatever transaction you want to do. And it's important because it is the guiding, it is that guiding light to whatever you want to do throughout your journey as a fintech, right? You're going to, both when you're dealing with transactions itself and when you're doing any other thing, contract is at the heart of what you do. From the moment you get your co-founders, right? The guys that want to co-found or, invent, whatever name you want to use, co-innovate, start the fintech with you as a co-founder. You have to even start by drawing out, a clear agreement on the basis of how you guys are going to co-own this company. Else tomorrow, when the company starts working and start growing, and then there's differences between both of you, without any firm agreement, then there's going to be trouble, right, in how things are going to be, resolved, or what decisions are going to take, who does what, who owns what. So right from that very beginning, when you're thinking about that business, of course, you can't escape putting a contract together with whoever it is that you're bringing in to start that business with you. Are you doing any form of partnerships to help you get that business off the ground? Definitely you have to draw up, contracts, right? So different kinds of contracts will come into different phases of what you do as a fintech. But it's very important that one of the things that a lot of our young innovators that are so in a hurry to innovate, most times nobody puts down anything on pen and paper. So a lot of things are just assumed. You have your best friend, you guys have been in school together, you guys have been colleagues at work, you guys just discuss this idea and then you guys just start, right? Because you guys are cool, you guys think you understand each other at that point because you guys are best friends and nothing is written down on paper and then you guys start, right? It's all good and it's all vibes and inshallah until, something happens tomorrow. And then you remember that there's actually no rules, there's actually no agreement between both of you on how things are done or how things are shared between both of you, right? Everybody has its own feeling of entitlement to what they feel they deserve, right? Same thing when it happens with your customers, you just want to sell, right? You have a product, you just want to sell so that you can test, your idea, right? You don't put any terms and conditions together. You don't put any form of agreement with your customer. You just want to sell. And then you sell this to your customer, or the guy does the transaction, with you, and then tells you, hey, there's an issue, I want to return it, or I want to refund, or I want to do this. And then you say, no, we don't refund. We're like, so where did you tell me? You didn't tell me before I bought. And now you're telling me you don't collect refund, right? Because there was no form of agreement, there was no form of contract that they are centered to, which is why when you're using most applications today or most device today, you see one long list of terms and conditions that nobody ever reads. Just scroll down and just look. All we're looking for is accept and move on, right? But those things look like, they are jargons. You just want to get into that application or you just want to consume that product, right? Until when something happens tomorrow and you complain and they tell you, hey, you gave us consent. You accepted our terms and conditions. It is part of our terms and conditions which you accepted, right? So those contracts are very, very important. A lot of times when you click that I agree and run, you don't know that you have told them that they can use your data, they can use your private information to do this and this and that. So when Facebook, you want to log into Facebook and Facebook give you one long thing and just scroll down and say, I accept. You've already accepted that they can use your data, to learn about you so that they know the best kind of ads to show to you, right? And then tomorrow you complain that Facebook, they have access to my data, they're looking at that. But you agreed to for them to look at your data, to learn what you're doing, what you're chatting about, so that they'll be able to know the kind of adverts to send to you, right? So those contract looks, a lot of times we don't put them into cognizance because we are in a hurry, to do things until when there's a problem. So contracts on the transaction side are also very important with your customer, whether they are paying for something or it's free. Even when something is free, there should be terms and conditions on which those services are being used, right? So you as a legal person, if you're a legal person out here and you're in legal tech, one of your most important roles is being at the heart to say anybody or any tech company or any fintech you're associated with, what are the documented contracts or agreements, whatever name you want to call it, terms and conditions that guide everything they do, whether it's partnership, whether it's selling to customers, whether it's even employees, right? Even when you're coming to a company, part of your onboarding is they give you conditions of your employment and things you want to do. All these things are documented, right? So contracts are on their own, financial transactions are on their own, but that handshake between both of them is where you need to document the terms and conditions on which those financial transactions should happen. And both of us have to mutually agree before I engage in actually doing that transaction with you, right, as a fintech, so that when tomorrow something happens with my transaction, I can be able to bring back what you agreed or what you assigned to, right? That this is what we had already told you, and you agreed before you did this transaction. On the presentation, it was a quite put together presentation. Just that when I skimmed through it, I think I joined towards the last part of the presentation. There wasn't a lot of case studies or examples to drive home some points. A lot of times when people make presentations, you might not get most of what they say, but when they give live examples, you can relate to it. And those examples are what sticks to you going forward than even the core presentation themselves. Because with those examples, it can now be real to you. So probably try to bring out a few examples, real terms in future presentations. I also saw where you mentioned under the contract part, smart contracts. So when we talk about contract, I always see people always like to throw in this whole smart contract concept, right? But the truth is, when you bring in smart contracts and when you're talking about types of contract or different examples of contract, you brought in a totally different concept into the equation, right? Because smart contract is not necessarily a contract type on its own. It's a totally different infrastructure used to execute, right? A logic or agreement on how something is supposed to run, using a distributed infrastructure, particularly known as commonly within the blockchain network, right? Or within the Web3 infrastructure. Basically, you're self-executing a logic. So in Web2, in the normal internet or in normal applications, what we call logic, what happens, what makes you be able to see Amena in Zoom is because somewhere behind the codes of Zoom, it has been, or the logic has been put that when you click on start video, something should trigger and tell the cam on your device to come on so that people can see the next person. So that logic has already been imputed into the codes of Zoom, that anytime somebody clicks start video, it should go and trigger or turn on the cam in the device that the person is using. So that logic making that thing to execute when you click on start video on Zoom is akin to what you do with smart contracts on the blockchain, whereby you put the logic on what should happen in a particular transaction, so that once that thing happens, when someone clicks start video, so when a transaction event occurs, a welcome should be activated. So whatever outcome you put in that smart contract, should immediately execute, on its own, right? So the concept of smart contract is whereby you now bring in, another kettle of fish around the blockchain. So if you mix it with when you're just talking about, different, categories or different kinds of contract types that you were listing before, peer-to-peer lending agreements, or I think you listed a few types of agreements earlier. Smart contract is not a type of agreement. It's just an infrastructure of executing particular actions, right, in the blockchain environment or in the distributed ledger environment. So it's easy for us to confuse both concepts just because the name is contract written into it, but it's a totally different concept. So that we don't always keep mixing those two things when we are talking about documentation of contracting in our normal fintech day-to-day running. Web 2, that is a Web 3 concept. But overall, I mean, the guys did quite a good job with the presentation so far. I think this set has been taking it one step extra, to really dig into a lot of research, when they're putting their presentations together. So, good job overall. The guys did well. Yeah. And lastly, please use larger prints. If you have to use less words on presentation, the better. Your presentation was almost, in some of your pages, you're almost like note copying. PowerPoint is not much for note copying. A lot of people do that mistake a lot of time. So don't use tiny text, like you practically want to write a note. Summarize as much as you can to bring out the core thing that you want to show people, and let it be bold, let it be beautiful. And that's why you're presenting, right? You're not writing or reading, right? But nice job, well done, guys.
Thank you so much, sir, for creating time for us, even though I know the time is a bit tight for you. Thank you so much. We can't thank you enough for that. I can see that Mr. Peter Paul has joined again. So you can continue with your comments on the presentation. We missed the most vital parts of your comments earlier because of the network issues. Mr. Peter Cole, if you're there. I'm sorry, sir, we still can't hear you. Okay, while we wait for our mentor to find stable connection, you
can you hear clearly now?
Yes, we can hear you, sir. We can hear you now.
Oh, all right. First of all,
much clearer. Oh.
But the network and seamless technologies is still not fully developed there. We're hopeful that there are innovators in the house who will also emerge with not only fintech solutions, right? Well, solutions to address all the problems we face. Well, but today's session is about fintech, right? Fintech transactions and contracts. And I wish, now that I know, it appears as if my opening statement and outline wasn't clear enough due to network issues. But I did mention a couple of things, which is the fact that the fintech industry, as we know it in Nigeria and Africa as a whole, is growing in leaps and bounds. It's an industry that has immense potentials. Now, I mentioned that as a Q2 this year already, the sum total estimation of transactions in the fintech space in Africa are close to net of $1 billion already, as we know it. Now, previously last year, these projections were for the worst. They were estimated that by the end of the year would barely have come close to that figure. But that's just to show the sheer size and the potential of that market. The last speaker did the last mentor did a very fantastic job in just dissecting and breaking down the concepts and the very different parts of it. So I will not want to repeat what has been said already, because of course, when someone like that goes before you, you just have to just follow in line. But to speak specifically to the presentation, like I tried to do earlier, it was a very, very good attempt, right? Touching on the fact that the various aspects of it were well addressed. Essentially for me, what stood out for me in the presentation was the fact that in breaking down the elements of what constitutes a good fintech contract, again, referring to the mentor before me, that mentor had specified the need for there to be clarity of the agreements. Now, contracts are essential to fintech transactions because you don't want to leave anything open. Whether you're working with collaborators, whether you're working with technical developers, whether it is customers alone, the issue of terms of use, the other different things, we have to ensure that everything is reduced to an agreement form. You don't want to proceed and wait till your innovation has blown before you decide to legalize things. That's what we advise startup owners. Don't wait till you've raised Series B funding before you start thinking about the legal aspect of it. And that's where contracts comes into place. There is no reasonable, sizable, significant transaction where there is no reasonably drafted contract. A lot of times, the reason startup owners and innovators lose out when it comes to funding is when they do not pay attention to contracts, right? So you have a very brilliant innovation in place, but the innovators have not paid attention to ensuring that they get vital, core, and solid legal advice in that extent. And that's where the role of a lawyer in the space comes in. You have to ensure that the agreements are well drafted, they are well reviewed, and that they cover the intricacies. And more specifically, every single detail is not left out. There was a mention of the issue of data. A lot of times, because of the nature of the business, data is the fundamental part of the business of the fintech industry. You want to be able to use people's data, but you want to do it in a way that does not also breach their personal rights to data privacy. Right? Recently, we had the emergence of the Data Protection Act in Nigeria, which we've all commended. Right? But another job the legal personnel and even startup owners themselves is to ensure that in the use of data, you continue to mine and use and apply the data of your subjects, of your customers, of your consumer in a manner that does not breach their own rights and does not breach existing legislation or previously regulation. You know, we used to have the NDPR, that's the Data Protection Regulation, but now the Data Protection Act has clear fundamental regulations with respect to the usage and the application of data. So these are essential parts of it. Even while drafting agreements, so you have to be careful around that. Even if certain persons have ticked a box to say they accept, there are also ethical questions around it. Does accepting once mean accepting all the time? The fact that I gave you my consent, these are questions that have to be properly considered as well. But in all, back to the presentation, it was a very good presentation. The mentor before me again took his time to analyze what could be done better, not only from a legal point of view, but also from the aesthetics of it, how you can improve your presentation skills. Yeah. Also, additionally on that point, I'd like to say that given this was a team presentation, right? I really hoped that there would have at least been more than one presenter, right? The single presenter did a very good job solo, right? Variety solo is fantastic, but having someone beside him who also understood the concept, understood the presentation would have been better as well. Yeah, so those are all the talking points. and areas of improvement. But in all, as I say, life is all about improvements, right? You always have to take away something from everything you've done right and what can be done better. So these are the things that can be done better. Very well done to the presenters, and your future in the fintech space is guaranteed if you continue to ensure that you take away all these points and you improve personally and professionally. Once again, thank you to the mentor before me. That was a fantastic session, and also to the presenter as well. Thank you very much. Amina, over to you.
Thank you so much, sir. Now that we can hear you clearly, everything is sounding perfect. Thank you for that. We missed a lot on the previous statements that you made. So I'll be taking questions from our mentees. If you have any questions, you can raise your hand so that I will call on you to ask the mentors directly, because we don't have any questions on ground. You were supposed to drop questions. Okay, thank you. Gloria.
Yes, I'm not actually a mentee. I think maybe Joseph will give a bit of an introduction. But
Okay.
that being said, so my observation in this meet in the training slides, right? I understand the dynamics of the fact that the presentation is around fintech transactions and their contracts, right?
Yeah.
But one of the things that I want to challenge the mentees here is I understand that some of you are law students, some are young professionals, and some are fresh graduates, right? So when you're doing, one of the things that is missing in that presentation is you have to understand the key players in the fintech space. And what do I mean? So when we say key players, the fintech space is very broad. There are a lot of participants. We have the cryptocurrency, we have I'll call it traditional fintech, that is those that are regulated by the CBN, right? We have the fintechs, those that are regulated by SEC, that is, for example, companies that provide investment products using technology, right? We have, so these are the three broad industry in the fintech, right? Now, beyond that, you want to look at, for example, CBN. Under the CBN licensed entities, you have to look at who are the key players. So what another thing you do is you look at the guidelines of the CBN. You realize that there are different participants there. You have example, you hear of the mobile money operators, you hear of the PSS, that's payment solution service providers. You have the PTSPs, you have the PSSPs. I'm sure you must have heard of these terminologies, right? So it would have been nice if we understand. So another thing is, it would have been nice if we understand that you understand the basic terminologies in some of these things, right? So if you're drafting a contract, understanding it and also understanding the underlying transaction, right? So example, if a customer tells you, or your client, all of us here, the mentees, all of you are lawyers, right? So if you're working for a company, you understand the dynamics of that company's operations. If you have an instruction to draft a contract, you need to understand the dynamics of that transaction. That is what gives you um that is basically like the background for you to draft whatever contract you want to draft. So let's say, for example, a customer or a client comes to you saying, you know what, I want to provide open banking, right? Open banking is another segment of fintech. So you say, I want to be able to provide open banking services. Again, just so that I don't delve too much, there are a lot of services provided under open banking, right? And then the customer comes to you to say, this and this and these are what I want to play in. This is what the other person is playing in. What is the first thing you do? The first thing you do is, first of all, understand the instruction, look at the guideline, right? Because the guideline, so contracts, again, let me go revert back again, right? When you're drafting a contract is not just to guide contractual obligations or contractual expectations. It's also a regulatory mandate. So there is example under CBN or what SEC, right? You have to ensure it stipulates that if you are licensed under these regulations, whoever is your customer, you must have a stipulated or a well, executed SLE, service level agreement, with these your customers, which means that it is not just a contractual obligation, but also a regulatory requirement, right? So once it is a regulatory requirement, what then happens when you I'm going back to open banking again, right? You have the open banking, you look at the open banking guidelines, you realize that there are stipulations there on what is required of an SLE. What are the things that must be in that SLE, right? Now, beyond that, each of the segment of the services that your client or your company or yourself provides, right? Look at the different guideline that speaks to it. Example, if your client is into mobile money operator services, you look at the MMO guidelines, there are stipulations there that must be in your contract, right? If you look at the PSBs today, that's payment service banks, right? There are stipulations there that speaks to what must be in your contract. If you look at the switching guideline today, there are specifications there that speaks to what must be in your contract. So that should guide you beyond just understanding or putting in place what is required between two parties or two contracting parties. Also stipulate those, ensure that there is compliance in terms of what is required in the contract vis-a-vis the regulations, right? Now, beyond this, you're speaking about cyber security and all of that, right? So again, you look at the example, CBN implemented the cybersecurity risk-based framework that came in. It was implemented. It's implemented, like when I mean implemented, I mean that the CBN mandates that is the commencement of that regulation was in January of this year, right? And it speaks to a lot of requirements, including what must be in your SLE for each segment of your services, to HR, to your IT team, to everyone involved, right? So again, this speaks to when you're talking about the challenges in when you spoke around cyber attacks and all that, right? Now again, it's not just about regulatory. Again, there's a slide where you spoke to the regulations that applies to um fintech transactions. It's not just about regulatory frameworks. There's also what they call there's what they call payment schemes. So for each of those payments that you've mentioned, the example, the NQR, there's USSD, there is there's USSD, there is NQR, there is pay with bank transfer, there is card, there is contactless payments. USS is also a contactless payment, right? So out of all of these things that you've mentioned, there is what they call payment schemes applicable to each of them. One of the most profound is what they call the payment card schemes, right? So the card schemes also have regulations that are applicable. You must abide by them. So it's beyond just what the CBN is saying. You must also abide by what the payment scheme rules are saying. So again,
Hello. Um. Okay.
hello.
Yes, we lost you for a bit more.
Okay, okay. So what I don't know what I said last, but what I remember I said depending on where your customer is playing in, that is the dynamics of the role your customer is playing. That also guides you. Let me give an instance, right? Let's say your client is a payment facilitator. When I mean payment facilitator, there are a lot of them. Example are the ones you've mentioned, Flutterwave, InterSwitch, there's Coral Pay, right, that provides switching services, payment facilitation, processing, and switching to customers. Now, most of these players have what they call this, they are being sponsored by the banks who are in this particular, for this particular dynamics, they're playing as acquirers, right? So they sponsor the transactions that goes on in the network of the payment facilitator. Now, so if you look at the example, if you look at Visa today or MasterCard or Verve, right? If you look at their rules, you see where they are. There are a lot, so they have like more or less like a guideline or framework that applies to each of those participants, including when it comes to fraud, when it comes to chargebacks, when it comes to settlement, when it comes to data protection, when it comes to cyber security, right? So it gives you a run through on what the expectations are. And I don't know if there is anyone here who is like a compliance officer. So these are some of the things that you look out for. So as one of the things I want to challenge each and every of the mentees here is, if you've not started doing it beyond what you guys have done, right, which is, I believe is a collective effort, right, you need to start understanding, not just on understand what your customer does, and also understand the regulations that are applicable to it. If you have an instruction to start drafting a contract, don't just rush into it. Understand the dynamics, understand the regulations that apply, understand not just the regulations, but also understand what they call industry trends. I'll give an instance, right? You have a customer that comes to you saying, I want to develop a solution that provides this. And that solution is basically like a fintech solution, right? Now, the customer is not, I keep saying customer, client is not a licensed entity, but they are providing a solution that if you want to run it, you have to be licensed for it, right? What do you do? Now, I have an instance, right? Practical instance where someone have developed something like that, and at the end of the day, because when you want to engage the banks and partners and all of that, they will tell you, you know what, do you have this approval? If you don't have it, it raises a red flag, because there's what they call compliance due diligence that they conduct for such kind of transactions, right? And then based on the checks and balances, they say, okay, you know what, let's go ahead with this transaction. So when they realize at the end of the day, there were a lot of setbacks, right? So they needed to go back and apply to the CBN. Now, guess what? They've already collected funding from investors for that solution. And because for them to push out that solution, they need CBN approval, which, of course, that one is another discussion in its entirety, right? So, because of it, some of the funds were locked. Now, if you're a lawyer that is advising that customer when they were during the fundraise, you also need to understand the dynamics when they're speaking to the CPs, that's the condition precedents or the condition subsequent. You need to also put in the fact that that solution that is being done is subject to CBN or regulatory approvals. If that is not in your document or in your contract, I don't know what else could be there, right? I'm just, these are some of the things that you consider. I would have, but for the sake of time, I will not really want to delve into maybe looking at each of the mentees that are here, right? What they do and how we can best advise on scaling based on their career trajectory, right? So I think I'll end it here. Thank you.
Thank you so much, Ma, for joining us on such short notice. I wasn't informed earlier, and I feel guilty that I didn't give you a proper welcome. Thank you so much, Ma. So we're taking questions from our mentees now. If you have any questions, kindly raise your hand so I can call on you. Before that, okay, while you are doing that, it's picture time, so I would like all our mentees and mentors, if possible, if convenient, to please turn on their camera so I can take a screenshot for our social media pages. Thank you so much as you do so. Our mentees can also take screenshots on their phone so you can make your posts using them. Thank you so much. I was hoping Mr. Peter Cole will also turn on his camera because he's okay. Thank you, sir. I'm sure it's not every day we get to see you wearing trads. Okay, can you please turn on your cameras? Thank you. I'm only seeing 4. Okay, 5, 6. Okay, I'm only seeing 6 faces here. Okay, 7. Okay. So I'm taking the screenshots now. Thank you so much. Okay, I'm done. Thank you very much.
Now we cannot hear you.
I'm so sorry. I didn't know I muted myself mistakenly. Okay, we have one speaker. I think this is our mentor. Okay, sir, you can go ahead.
Okay, thank you so much. And I really want to thank the presenters for the presentation. I think it went very well. And also for the mentors for the comment they've made. But particularly, I think Gloria Imomose made some comment, very long, but again, a lot of points she made, just for us to understand the backdrop of the fintech. There are a lot of regulations, layers and layers that needs to be considered, and our legal people on the call, they have a role to play. From what I hear her saying, there are levels and layers. You need to understand your customer very well, and the industry they play in. A layman like myself, I'm just an engineer joining the call just to again enrich my knowledge on some of the things that are going on here, and I think I've benefited a lot. But the question I want to ask is this: if there's so much rigor, in the financial space in terms of regulation and what needs to be done, and checks on transactions and how things go, why is it that when fraudulent activities take place on people's accounts, the bank make it look like they don't have any part or any role to play? They sound like there's nothing they can do. There's no guarantee that the bank is going to give you or if they have done what they need to do, have all the cybersecurity protection as has been talked about by Gloria Momose, then why don't they take responsibility for that? They just make it look like, you're on your own. Go and deal with the issue, and the bank doesn't take responsibility. I'm a bit confused there, because if there are almost 5 layers, MasterCard, Verve, and all the other layers she talks about, condition precedent, it sounds like so many layers have been put there already. Why can't the bank take responsibility when fraudulent activities take place in people's account and people are ripped off? They come and they cry at the bank, but nobody pays attention. That's just my question. Thank you.
Okay. I'm going to direct this question to Mr. George, and then maybe the other mentors can. Yes, sir.
It's a very interesting question that we've all asked ourselves, right? And even though we know the answer, the truth is, privacy policy is a double-edged sword, right? It can protect you it can also frustrate the ability for you to get protected. So when you see, let me paint another picture for you. When there was a bomb issue sometime not too long ago from some twins in the US, one of the phones of the terrorists or the presumed terrorist attackers were recovered, right? But Apple refused to hack into the iPhone of the guys, citing privacy policy. Now, this is our guys that are terrorist suspects, right? That their activities killed innocent Americans, right? But the company refused to open or hack their Apple phone that was recovered for further details for privacy policy reasons, right? Because if you justify it in this case, every situation is justifiable to get the company to hack anybody's phone. And then it becomes, they set a precedent which they always don't want to set. And then it gives the precedent for the law enforcement to have every justification to hack every American's phone. Bring it down to Nigeria, there are policies and regulations that guide against what banks can do with your account. It's the reason why if there's no letter, if there's no court judgment, nobody can do anything from your account. So while the bank you have a fraudulent transaction and you complain that this particular person ripped you off and that this money is in this person's account and this fraud was committed by a so customer of this bank, and you go to his bank to complain that their customer have defrauded you and the money you're talking about, they are seeing it in that account, they can only institute a process of investigation that will move that case away from the bank into some set-up authority by the regulators. But the bank cannot take executive judgment and decision to find the person guilty, to go into that person's account and then probably give you your money back or do something else. They can only do that via advice from a process of investigation by the authorities and a court judgment, because they also have privacy-related regulations that guide the rights of account owners, because they are not in the position to investigate whatever complaints that you're making. So privacy laws is a double-edged sword. That on one hand is to protect you and you're all fine and cool, that nobody can get access to your information without your authorizing it. But on the other hand, it can leave a very sour taste, when it impedes you from getting the necessary support or the necessary protection that you're supposed to get when you're ripped up or defrauded, like the example you just gave. Is the sad situation of the double-edged sword of privacy policy. So you must take that to the authorities. The authorities must investigate. The police and probably get some court judgment to enforce, give the bank the authority to do any other thing with that customer's account. Else, they have no authority or right to do it. They can only, at best, if the case is very, 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 very clearly suspicious, the best they can do is to put a temporary freeze on that account. And that freeze is very temporary. If it exceeds a certain number of days and there's been no further communication from an authority like a police investigating that place, they will be forced to lift that freeze, for the customer.
Thank you so much, sir. It seems to be the only question we have for today, so I'll be directing it to the other mentors to add something maybe. Mr. Peter Cole, if you have anything to add to that. Mr. Peter, are you with us? Okay, then I'll call on Miss Gloria to add something to that.
Hello, I mean,
Yes, we can hear you, ma'am.
hear me.
Yes. Yes.
The network is terrible. Hello.
Yes, we can hear you, ma'am. I can hear you from my end.
Okay. I mean, I don't know what's happening to my network, but it's
Yes, I can
very
hear you from here now.
unstable.
You're breaking off.
I did not hear what. Yes, what was the question again?
Okay, Mr. Okay, can you
Or
take the
can
question?
you drop it in the Dropbox, the chat box, as I can't hear you?
Okay, I can just summarize the question again. My
Okay,
question
what
is
was the
just very
question? I
simple.
lost you. What was the question?
Okay.
What the question was? I lost. My network is terrible.
Okay, can you hear me
Okay.
now?
Okay.
Yes,
Yes,
we
it's
can hear
better
you.
now.
Okay, I'm just asking why banks don't take responsibility for third-party fraudulent activities on their customers' accounts, knowing that there are layers and layers of security that they should have had on their account as the bank responsible holding the client's account. You have third party going to people's accounts, let's say OPay and all that, third party hacks in and removes funds. But bank hardly take responsibility, even if it's expected for them to have cyber security or layers and layers of security to protect people's funds.
Okay. So when you said that, the first thing that came to mind is the BVN guideline. What you're speaking to, the BVN guideline provides for when there's loss of funds, what happens, right? Now, there's also like the fraud desk guideline of the CBN. There's what you said, there are layers and layers of processes. If a client comes, so again, the customer, or let's say the bank, right? Let's use the bank. The bank cannot. There are layers when it comes to financial transactions. You need to understand that there are different stakeholders, right? Depending on the channel that the transaction was carried out, right? You need to understand that. Let's assume that it's through a POS. There is the POS agent. There is the super agent or the agent institution. There is the PTSP involved. There is the switch involved. Then there is the issuer bank, which is the bank that you're speaking to. That's the customer's bank. So in this POS transactions, there are about 4 layers of stakeholders involved, right? So if a bank, now your question again is very tricky. I cannot say yes or no because I do not understand the perspective, or are you coming from a customer angle, or you're coming from a payment stakeholder angle? There is a so my response will differ
From a customer
depending
angle,
on where.
please.
Now, from a customer angle, first of all, you need to understand that when fraud takes place, right? It could be even from the customer. The customer, in one way or another, there could be a compromise. Now, with the banks, remember the banks are one of the institutions in Nigeria that are highly regulated, right? By the CBN. They have, so example, now when it comes to security, they have all the security that you can think of, really. When it comes to, there's what they call the International Security Organization, ISO. They have the ISO standards. They have the PCI DSS standards, right? They have the standards. In fact, they even ensure that their partners or technical service providers also have those standards because it's mandated by the CBN. So when there is a fraud, investigations will need to be conducted to know where that fraud is coming from. or who perpetrated the fraud, right? So that's why when I said that that question is very tricky, because that a customer's fund was defrauded does not mean that it's necessarily from the bank. It could be from the customer, it could be from the network, the payments network, it could be from any angle. So the question will then depend on what is the results of the investigations done, at whose end was that fraud committed, right? So that will then, and that question, that the outcome of the investigation will answer your question really. But again, looking at it from the perspective of this conversation, of this section that we are having, right, it's one of the things that you have to look out for in your contract, especially if you're providing a service to a bank, right? You need to look out for whose liability will it be if there is a fraud committed. You have to clearly state it. If you're acting or directly engaging with a customer, you have a solution that directly engage that is. So what I mean by, you have a solution that the customer is onboarded directly on, and there is funds involved, maybe a wallet. You have a wallet as that they are specified. I wish I could share line there. You see where it specifies that it has to be clearly stated on whose end or liability, the liability as regarding funds when there is a fraud. On whose end will it be? Who is responsible for who? It has to be clearly stated. But if you're a lawyer acting for your customer, right, you have to look out for some of those things. If you're a lawyer acting for the bank, you have to ensure that the liability is not on you. So again, it still then depends on who you're acting on behalf of. Thank you.
Thank you so much, Ma. I'll still call on Mr. Peter Cole to give us his own opinion on the question.
All right. Can you hear me this time around?
Yes, sir, we can hear you now.
Thank you very much. Well, I think that with respect to the dynamics of the question, I felt the question was a bit double-sided, right? Gloria did a fantastic job to review the different dynamics to it. Now, the truth is that when it comes to the issues of fraud and breach of security or the hacking into the account of the customer, there are several angles to it, both from a regulatory point of view and also from a point of liability. Now, in the first place, you have to understand that when it comes to the breach of that cybersecurity network to be able to hack into a client or customer's data, there can be various means via which the hacker or that scammer was able to get the information. And one of it, which cannot be ruled out, is probably perhaps the liability of the customer himself in the process. But we're not dwelling much on that. The truth is that, yes, to answer that question directly, yes, banks do bear liability in instances. I can speak to that as a fact, because on a daily basis, we do see instances where traditionally, right, the attitude of banks towards issues of fraud is not to instantly run away, right, but also to first comply with, because of course there are steps and procedures from a regulatory point of view they have to comply with whenever a fraud has been reported or a breach of accounts has happened. Now, to just add to that, you find interesting the fact that it is estimated that on a daily basis globally, right, the rate of attacks or hacks into the banking industry is into hundreds of thousands, if not more than that. But only the big ones get announced, right? So this is, no matter how very advanced, no matter how secure, the truth is, as security systems get advanced, as banks continue to improve their cybersecurity, so also do hackers. Hackers also advance as well, right? So systems are there to be breached. But the requirement, those standards that have been put in place by regulator, the question is, are the banks compliant to that extent? If that is in full compliance, then it cannot be said that such breaches will be placed at the doorstep of the bank. Again, now there are also regulations clearly that stipulate for process to compensate customers. So if a customer has suffered a breach of his account and funds were moved out, it behoves on that customer to go through a legal process to be able to recover it. Again, like I said, I am aware and I am certain and definite that in many instances, many now, banks do bear liability for such a breach of customers' funds and the removal of it. So it is. So I don't think it's accurate completely to say that it doesn't happen a lot, right? But in the instance that the other scenario has happened, it behoves on the customer to be able to prove not again. It's not certainly the responsibility of the customer to now have a higher level of security other than that the bank will provide him. Because again, in the first place, the reason the customer would leave his funds in the banking system is because he entrusts himself to the security and the standards that the bank promised with respect to the safety of his funds. Right. So there is definitely a corresponding obligation and responsibility, both from a regulatory and ethical moral point of view for the bank to ensure the safety of those funds. But everything has to be done in a manner that is in compliance, full compliance with the standards, the regulations, and the demands of it. So I hope that settles that. So there are always two different angles to it. First is the responsibility, the obligation, ethical, regulatory, and the framework that financial service players, whether deposit money banks, whether MMOs, whether different persons that, again, I think Laura was referring to the different layers, the different regulations and specific industry specific regulations that each of these service providers have to comply with at all levels. So once this compliance system is in place, the idea is not that there are extensive or limitless or endless systems in place. It's just to ensure that these standards are complied with, and when there is a problem, liability can be properly apportioned. And when it is properly apportioned, then the party that has been wrongly breached or that suffered a sort of liabilities will be due to receive what is due to them. So, yes, in truth, customers do get reprieve, as they should actually. Of course, from moral point of view, also, it is not right, certainly not right for the customer to have to bear liability for the inability of a bank to do its job. But also vice versa, right? There are always two sides to a coin, like I said. Thank you.
Yeah.
Thank you so much. Okay,
But
okay.
I mean, let me just add something here. Look, if we've been using the word, we've thrown in the word cyber breach a lot of time in this conversation. If there's a cyber breach on any bank, I don't think there will be any case in any bank where there will be a cyber breach and the customer bears 1% of the cost of that breach, right? Without even, in fact, the truth is that there are a few of them that happens that most people don't even know, right? The bank just bear them, do their internal thing with the regulators, and replace customers' funds. If it's a breach of your account, not the cyber breach on the bank, if it's a breach on your account that comes from probably your lack of managing your access to your account appropriately, well, like for example, where you have somebody have access to your ATM pin, and have access to your ATM card, and then the person goes to an ATM machine and withdraws from your account, right? You have a responsibility on your password or your PIN, protecting your password, your PIN, and your card, and also to report immediately either is stolen or taken under duress or vice versa, for the bank to put a block on your freeze on your account. So if it's a personal breach from your own end, the most the bank can do for you is to try to see how they can help you, in facilitating recourse from the destination account that's enjoying that money. If it's not an ATM withdrawal, if it's an ATM withdrawal, they have the pictures of the guys that withdrew from the ATM, right? But the bank will not necessarily replace that money because it's not a breach from the bank. It's different from what you're talking about, a cyber breach on the bank, where the bank bears 100% of that loss. And that one doesn't even take a lot of time. But if it's a third-party breach on your account, whether you were defrauded by somebody that you did a transaction with, whether you were coerced into sending money to another account, whether someone had access to your ATM or your phone or details to getting access into your account, probably you didn't protect your password well, or it was under duress, then the bank can assist in the investigations, but the bank definitely won't be 100% of that loss because they are not live, in that situation, but they would assist. But their assistance is relative to, privacy policy on the other party, that they are dealing with. But if it's a cyber breach, 100% the bank will, and they do it all the time. Just a lot of times customers are not even aware. The bank could be at the cost 100% if there's any hit on the bank's own infrastructure. Yeah, just thought to add that. So we're mixing all of them up.
Okay, thank you very much, sir. Mr. Okay, do you want to address anything concerning the question?
Okay. Thank you, Amina. I think I have more than sufficient information and feedback already from the mentors and from the lady that spoke. I have that feeling now that, I can always advise people to say, oh, there are legal backings or there are layers of information you need to look into to see if you can get that refund. I think I've gotten that strong commendation from the mentors that your funds can't just get missing, and maybe it's a misconception from my own part, because I've had people that lost money, they never went to the bank. They just swallowed it and moved on, right? So what I hear is that there are layers and layers of engagement with the authorities, and if in cases where you are not responsible, the bank is responsible, at least, if not to make 100% refund, some level of refund that compensate, and it gives me that one feeling that at least something can be done. So I do appreciate the comments from the mentors, as well as the comments from what's her name again, that made the comments, Ms. Gerald. Okay, thank you so much. I appreciate it.
All right, thank you so much. At this point, we'll just leave our mentors to go tend to their other commitments. I don't even think they'll be here for as long as this. Thank you so much to our mentors. Thank you so much, Mr. Peter Cole. I don't know if he's still on the call. He's here. Okay, thank you so much, sir.
Yeah, thank you very much. Thank you for having me. Thank you to all the mentors as well. Very fantastic illustrations and analysis. Thank you very much.
It was a wonderful section. Thank you so much, Mr. George and Miss Gloria. I apologize once again because we were expecting you, but I didn't know you'd be available for the class. Thank you so much for creating time to be with us. We really had a wonderful session. Thank you so much. Bye, everyone.